The second half of 2026 is not a time when I want to blindly buy whatever has the strongest chart. I want businesses with strong earnings, durable competitive advantages, real cash generation, and enough long-term growth to justify owning them beyond the next 6 months. And valuation still matters. A fantastic company can be a terrible investment if expectations already require perfection. So these 7 stocks are not predictions for which names will rise the most before December. They are the businesses where I see some of the strongest combinations of quality, growth, resilience, and risk-reward today. And when I say I'm buying heavy, that does not mean putting half the portfolio into one stock. Conviction tells me what I want to own. Position sizing determines how much risk I'm willing to take. With that framework established, let's start with number 7, the least flashy company on the list, and maybe the best counterweight to everything coming later. Number 7 is Berkshire Hathaway. This is not the stock I expect to dominate conversations about artificial intelligence. That is exactly part of the appeal. Berkshire combines insurance, energy, railroads, industrial businesses, and a massive investment portfolio under one roof. And as of June 30th, its insurance businesses held roughly $210 billion in cash, cash equivalents, and U.S. Treasury bills. That liquidity creates enormous optionality. Berkshire can make acquisitions, buy securities when markets become attractive, repurchase shares when management sees value, or simply earn income while waiting. The downside is scale. A company this large becomes progressively harder to grow rapidly, and the transition into the Greg Abel era adds an execution variable investors should monitor. So Berkshire is not here because I expect explosive growth. It is here because a portfolio filled with aggressive growth stocks benefits from owning a business that can thrive without needing the AI narrative to remain perfect. The next company also does not need an AI boom. Number 6 is Visa. I think of Visa less like a traditional financial company and more like a toll road sitting on top of global commerce. Every time more spending moves from cash toward digital payments, networks like Visa have another opportunity to participate in that transaction flow. The business model is attractive because Visa does not need to lend the money behind most of those transactions. That helps create an asset-light model, powerful margins, global network effects, and substantial cash generation. As of August 11th, Visa trades at roughly 21.5 times trailing earnings. That is not automatically cheap, but it is a valuation where I can at least have a serious conversation about long-term compounding rather than pure speculation. The risks are real. Regulation can pressure economics, alternative payment networks keep developing, and weaker consumer spending can slow payment volumes. Still, Visa gives this portfolio something useful, structural growth that does not depend directly on cloud computing or AI spending. And number 5 takes us even deeper into financials. Number 5 is JPMorgan Chase. If I want direct exposure to the banking system, this is the institution I am most comfortable owning through a full economic cycle. JPMorgan had roughly $4.9 trillion in assets at the end of March 2026. But scale alone is not the thesis. The strength comes from how many different engines contribute to the business. Consumer banking, investment banking, payments, commercial banking, asset and wealth management. That diversification gives JPMorgan several ways to generate earnings, while weaker competitors may be more dependent on one part of the credit cycle. The bank also continues to operate with substantial capital strength, which gives management flexibility around dividends, buybacks, and investment. But banks are cyclical. A recession can increase credit losses, regulation can increase costs, and unusually strong industry profitability does not last forever. That keeps JPMorgan below the top 4, because from here, the list begins moving toward businesses with much stronger structural growth. And number 4 is one of the biggest beneficiaries of AI infrastructure spending outside NVIDIA. Number 4 is Broadcom. If NVIDIA is the most obvious AI semiconductor story, Broadcom is one of the most interesting second-order beneficiaries. In fiscal second quarter 2026, Broadcom reported $10.8 billion of AI semiconductor revenue. That was up 143% year over year. The key opportunity is custom AI accelerators and networking, Large technology companies increasingly want specialized infrastructure designed around their own workloads, and Broadcom has positioned itself directly inside that trend. Then there's VMware. That gives Broadcom a major infrastructure software business alongside semiconductors, creating another source of earnings and cash flow. But this is where valuation discipline becomes critical. Expectations are already high. Customer concentration matters. And when a company is priced for enormous AI growth, merely delivering good results may not be enough. So Broadcom gives me powerful upside exposure, but I would still control the position size. Number 3 gives us AI exposure through an even broader business ecosystem. Number 3 is Microsoft. What makes Microsoft attractive to me is not simply that it participates in artificial intelligence. It already owns the distribution channels needed to monetize AI across millions of businesses. Azure, Microsoft 365, enterprise software, developer tools, security, and an enormous installed customer base. In fiscal fourth quarter 2026, Microsoft Cloud revenue reached $59.3 billion, up 27% year over year. Commercial remaining performance obligations reached $678 billion, up 84%. That backlog gives us a powerful indication of contracted future demand. And Azure itself grew 43% in the quarter. The risk is that Microsoft is spending enormous amounts of capital to support this infrastructure. Those investments eventually need to generate attractive returns. And at Microsoft's valuation, investors already expect exceptional execution. So I love the quality of the business, but I would not ignore the price. Number 2 has a similar AI infrastructure story, but with a very different earnings setup. Number 2 is Amazon. Calling Amazon an e-commerce company in 2026 misses a huge part of the story. AWS is one of the world's dominant cloud platforms. Advertising has become a major high-margin business. Retail efficiency has improved, and Amazon's logistics infrastructure creates competitive advantages that are extremely difficult to replicate. The latest numbers make AWS especially interesting. Second quarter AWS sales increased 37% year over year to $42.2 billion. At the company level, operating income reached $27.5 billion. That matters because Amazon's investment thesis is increasingly about the combination of revenue growth and operating leverage. If AWS keeps accelerating while retail margins improve, earnings can grow considerably faster than consolidated revenue. The risk is capital intensity. Amazon is spending aggressively on AI infrastructure, and investors are expecting that spending to produce major future returns. AWS competition is also relentless. Still, this combination of cloud growth, advertising, logistics, and margin potential puts Amazon at number 2. But before number 1, one quick interruption. If you like stock analysis that looks beyond the headline and asks what actually drives a business, subscribe to Boring Money Wins and hit the like button. The goal here is not to chase whatever stock is trending this week. It is to find businesses capable of compounding capital long after the current market narrative changes. And that distinction matters, especially for the number 1 stock, because my favorite risk-reward on this list is a company everyone already knows, but I think the market is still underestimating how much its earnings engine is changing. Let's get to number 1. Number 1 is Alphabet. And for me, this is currently the most interesting combination of business quality, growth, and valuation among these 7 names. The foundation is still enormous. Google Search remains a massive cash-generating business. YouTube adds another global advertising and subscription platform. But the part changing the story is Google Cloud. In the second quarter of 2026, cloud revenue reached roughly $24.8 billion, up 82% year over year. Cloud operating income reached about $8.8 billion, with an operating margin around 35.6%. That is no longer a side project. It is becoming a major profit engine. Meanwhile, Alphabet trades around 17.5 times trailing earnings as of August 11th. That valuation looks particularly interesting relative to the growth being produced across cloud and AI. The risks are serious. AI could disrupt traditional search economics. Regulation remains persistent. Competition is intense, and capital spending is enormous. But at today's risk-reward, Alphabet gets my number one spot, which raises an obvious question. Where is NVIDIA? Leaving NVIDIA out of the top 7 is not a bearish call on NVIDIA. It is a portfolio construction decision. The company remains one of the highest quality businesses in the AI ecosystem. But a great business is not automatically the best purchase at every valuation. And look at what we already own on this list. Microsoft benefits from AI infrastructure and software adoption. Alphabet benefits from AI across cloud, search, and its broader ecosystem. Amazon benefits through AWS. Broadcom benefits through networking and custom silicon. So adding another enormous AI position can increase exposure to the same underlying spending cycle. That does not mean avoiding NVIDIA forever. It means I want to evaluate business quality, valuation, and portfolio fit together. Because this is where a 7-stock list can become deceptive. You can own 7 different ticker symbols and still have far less diversification than you think. Look at the portfolio beneath the company names. Microsoft, Alphabet, Amazon, and Broadcom all have different businesses, but they share important economic drivers. AI infrastructure spending, cloud demand, enterprise technology budgets, and, to some degree, investor expectations around long-duration growth. If that entire narrative weakens at once, those positions could become more correlated than the ticker count suggests. That is why JPMorgan, Visa, and Berkshire matter. They add exposure to banking, payments, insurance, industrial activity, energy, transportation, and other parts of the economy. This does not eliminate concentration risk, but it improves the mix of business drivers. And this is also why I would never allocate the same percentage to all 7 stocks simply because they appear on the same ranking. Ranking a company is one decision. Determining how much capital to deploy is another. So the next question is how I would actually build these positions. I would not take the money I want invested in these companies and deploy all of it tomorrow morning. I would build positions gradually. Start with an initial allocation when the valuation makes sense, then leave room to add if volatility gives me a better entry without damaging the business thesis. And if earnings continue confirming the thesis, I can increase conviction over time. This does not mean endlessly waiting for the perfect price. Perfect entries usually exist only in hindsight. The objective is to avoid turning one day's market price into an all-or-nothing decision. And again, company ranking does not equal position size. Alphabet can be my number one idea without automatically becoming my largest position. Broadcom can have enormous upside while still deserving a smaller allocation because of valuation and concentration risk. Good portfolio construction requires both conviction and humility means knowing in advance what could prove the thesis wrong. Every stock on this list has a reason I would sell or materially reassess it. For the technology companies, one major risk is that AI infrastructure spending grows much faster than the profits generated from it. For JPMorgan and Visa, a significant economic slowdown could pressure credit, consumer activity, and transaction volumes. Across the entire market, higher interest rates can compress valuations. Regulation remains important for Alphabet, Microsoft, Visa, JPMorgan, Amazon, and others. And then there's the simplest risk of all. The company reports results that show the original thesis is no longer working. One bad quarter is not automatically a broken business, but repeatedly weakening fundamentals deserve attention. That is why I want to know what would change my mind before I buy. Hold forever no matter what is not discipline. It is refusing to update your analysis. With those risks clear, we can rank the 7 one final time, but this time by the job each stock performs. If I rank these companies by investor objective rather than simply 1 through 7, the picture becomes clearer. Alphabet is my favorite overall risk-reward. Microsoft is my highest quality combination of cloud, enterprise software, and AI distribution. Amazon offers some of the most interesting operating leverage if AWS growth and retail efficiency continue working together. Broadcom is my preferred pure AI infrastructure exposure on this list. JPMorgan is my favorite financial. Visa is the steady compounder tied to global digital payments, and Berkshire is the defensive counterweight with enormous liquidity and a very different economic profile. These are different businesses doing different jobs. That matters because a portfolio should not simply contain your 7 favorite stories. It should contain exposures that make sense together, and that leads to the principle behind the entire ranking. Alphabet, Microsoft, Amazon, Broadcom, JPMorgan Chase, Visa, and Berkshire Hathaway. Those are my 7 highest conviction names for the second half of 2026. But I am not buying them because I expect every one of them to outperform between now and December. I am buying businesses I would still want to own after the current market narrative changes. That is the test. If AI excitement cooled tomorrow, would I still want Microsoft? If the market stopped rewarding cloud growth, would Alphabet and Amazon still own valuable businesses? If the economy weakened, would I still trust Berkshire and JP Morgan to navigate the cycle? The answer has to come from fundamentals, not momentum. Find strong businesses, demand a reasonable price, control your position size, and keep enough diversification that one mistake cannot dominate the portfolio. The objective is not owning the hottest stocks, it is owning businesses capable of making boring money for a very long time.